Good morning. CRE risks in a higher for longer rate environment. What commercial investors and business owners must reprice now? And for more than a decade, commercial real estate benefited from declining interest rates, easy refinancing, and aggressive leverage. And that era has ended. But today's higher for longer rate environment is not a temporary disruption. It's a structural reset that is forcing investors, lenders, and business owners to reassess risk across every asset class. Now, understanding where CRE risk is increasing and how to manage it is essential for protecting cash flow, your equity, and your long term exit values. So, first is refinancing risk is the primary threat. So, the single largest risk in today's CRE market is the refinancing exposure. So, loans originated between 2019 and 2022 were underwritten at historically low interest rates. And as those loans mature, debt service payments are increasing 30 to 70%. And DSCRs that once cleared lender minimums are now failing. And many properties no longer support prior leverage levels. So, this is especially acute for office buildings, retail, and value add multifamily assets with floating rate bridge or short term bridge debt. And here's the key takeaway for this segment: and a property does not fail because it's bad. It fails because the capital stack no longer works. So consult a real estate broker, a mortgage broker. We can talk more. Two is cap rate expansion is pressuring values. So higher interest rates push capitalization rates higher, particularly in assets without strong rent growth or long-term leases. And when cap rates expand, property values decline and pull back, and loan to value ratios need to increase. So your equity cushion is going to shrink or disappear, is the sad side of that. But this dynamic is already visible in older office assets, non grocery anchored retail, and secondary market multifamily. Even stabilized assets face valuation pressure if rents cannot grow fast enough to offset higher debt costs. Three is cash flow volatility is increasing. Higher rates expose weak operating fundamentals. So think properties with thin margins or short lease terms or heavy tenant improvement exposure, and also rising insurance costs, tax costs, and maintenance costs are far more vulnerable in this environment. So cash flow volatility increases lender scrutiny and also limits your refinancing options. Now, in contrast, assets with durable tenants, predictable income, and conservative leverage continue to attract capital. Number four, exit liquidity is no longer guaranteed. Transaction volume has slowed, not because buyers disappeared, because the bid ask spreads widened. We couldn't get people to agree on prices. So sellers are anchored on yesterday's pricing, face longer hold periods, and buyers are demanding higher yields to justify the risk of making a new purchase. So what this creates is longer marketing times, fewer competitive bids, and a greater emphasis on seller financing or structured exits. Now, exit strategy risk must now be modeled years in advance and not just assumed. Number five, lender behavior has fundamentally changed. So, banks and institutional lenders are prioritizing balance sheet protection. And current trends include lower leverage limits, higher DSCR requirements, and greater preference for recourse for their loans. And also, with rising cap rates, more conservative appraisals. So borrowers with weak sponsorship or unclear strategy or poor documentation are being filtered out early. And this next segment is the strategic positioning in a higher rate CRE market. While risk has increased, opportunity has not disappeared, and it has simply become more selective. And here's some winning strategies to include to think about. But fixed rate or long-term debt structures, conservative leverage at acquisition, and assets with pricing power and durable demand, but also markets with population and employment growth. Now, West Houston, Katy, and Fulshire continue to attract capital due to corporate migration, medical expansion, and industrial demand. But deals must be structured correctly, is the overall thought. Now, in conclusion, higher interest rates do not kill real estate deals. Poor structure does. And the investors who succeed in this cycle will be those who treat capital as a strategic tool and not a commodity, and underwrite their risk before the lender does. So if you're evaluating a refinance, an acquisition, or an exit in today's market, clarity matters more than optimism right now. That, my friends, is it for the day. Please visit HoustonRealEstateBrokerage.com for free resources and also how to get a hold of me. Love to chat more. Have a good day.